Welcome to this Killik Explains Finance podcast. This week, my biggest investing mistakes and what hopefully you can take away from them. So, Winston Churchill, no less, once quipped that some of his best impromptu speeches took weeks to write. And the reason I mention that is that investing is actually ultimately all about practice, practice, practice. Otherwise, you're just essentially lucky as a novice. It takes experience and judgment to get investing right consistently, but it does help if when you make a mistake, and of course you will make mistakes as an investor, sooner or later, you don't repeat them too often. So this is all about 5 of my bigger ones and what I would take away from them. Now the first one, you can call it various things, some polite, some not. I'm going to call it irrational thinking. So an example, this was a big example for me. I kept buying Jarvis, a firm that's long since disappeared. Some of you may remember it. It was a huge rail infrastructure operator. And I kept buying it on the dips, as they call it, that famous expression, convinced that it couldn't fall any further and convinced that it was cheap. Now, I wasn't really doing my homework. I was just buying, following what I thought was a fail-safe system. The price eventually actually hit 0. And at that point, even people like me stopped buying it. Okay? And this is an example of following a system without actually doing your homework properly. It sounds snazzy, buy on the dips, and it can work. You want to buy when a stock is trending into a trough rather than peaking. Of course you do. There is a valid system called buying on the dips, but don't use it unthinkingly. And do not confuse price with value. Just because something's cheap doesn't mean you should buy it. And I was being a little bit lazy, really, and made that classic mistake. And I'm afraid that was an expensive mistake because every time I bought on the dips, the share price continued going lower. In other words, sometimes things are cheap for a reason. So there's number 1. Number 2, cutting winners. And there's a flip side to this which makes it even worse. So I sold Google shares many years ago, having banked what I thought was a fairly clever 25% gain. Well, 25% is 25%. Why not take that off the table? Well, the reason is that sometimes, rather than just applying a blanket system like that, recognize when a firm is actually transforming the sector it's in and has long-term monopolistic power, if you like, rather than just applying a simplistic formula to taking profits. Because the shares have gone up around tenfold since then, and you can compound it by basically, as well as not running your winners, people often hang on to their losers, hoping they'll recover. So you end up with this bizarre portfolio packed with kind of dog stocks you're clinging onto where your money could be working elsewhere, having cut all the stocks that would have actually made you some decent long-term returns. So, number 2, don't cut winners, and equally have the courage sometimes to sell losers. Number 3, herding. I made 2 mistakes here. I bought Henderson Technology, which you can still do today, back in 1999. I got in right before the dot-com crash on the advice of a friend. I thought I'd better try and join this party, late though it is, and then compounded the error by selling as the market fell in 2002. So essentially, this is not an accurate price representation, but essentially I made the classic investment error of sort of buying at just about the point everyone else had already bought, and then I sort of bailed out, panicking, more like in sort of 2002, and there's kind of very rough and ready 1999. Had I hung on, actually I'd have done okay. So I made 2 mistakes there by following the herd in and then panicking and following the herd out again. I didn't need to sell, didn't need the money back. I wasn't a forced seller. I just did it because everyone else was doing it. So there's mistake number 3. That, by the way, is the way most people end up buying high, which is what I did, and then selling low, which is what I did, the exact opposite of what you should be doing. So, number 4, anchoring. Now, I did this actually in the property market. I started working in London in the early 1990s when things were bad. Chartered accountants were being laid off left, right and centre, of all people. And in London, it was possible to lose money in property then. Hard to believe now, some would say, but definitely possible then. And a friend of mine did just that. Bought a property in a supposedly up-and-coming area and lost money just a couple of years later. and all the rest of us were then frightened out of the property market. Now, we did get back in, but we left it far too late. We clung on to this gloomy, bearish picture of London property, didn't recognise how things were changing quite rapidly in the period after that, and stayed out of the market much longer than was actually wise. It's a classic example of just being tied to the past and not recognising when the facts have changed. They changed, but I hadn't, in effect. And investors do it all the time. So fear is not always your friend as an investor. You should have the courage sometimes to recognise the facts have changed and go into a market which may be beaten up and battered, but long term looks like it can offer you decent returns. Finally, number 5, ignorance and pride, I've called it. And we've all done this if we're honest enough about it, and honesty is important in investing. I was once persuaded to start spread betting on the outcome of football matches, knowing frankly very little about football at the time and knowing even less about spread betting. But it sounded like a sort of fun thing to do, and I was talked into it. Now it is, for the right sort of person, with the right risk warnings and so on, a potentially fun thing to do. It's also quite risky if you don't know what you're doing. And the moral of this story is, if you don't understand something, do not expect to make money from it. If you're going to do a spread bet on the outcome of a football game, my favourite one used to be the total number combined of the shirt numbers of the goal scorers in the game. You can spread bet on that kind of stuff. If that's your thing, go for it. But make sure you understand that you're essentially gambling. You're not there as an investor. So gambling's for fun seekers and fools. It's not really for serious investors. And that's how I tend to treat something like that if I was going to do it. And I knew roughly what I was doing, which of course I do now. I'd just do it as a small part, a sideline, as a bit of fun, not as a serious component of my investment portfolio long term. So, in a nutshell, the challenge, if you bring all that together, the challenge often is this: investing should be relatively dull. Paul Samuelson, Nobel Prize winning economist, once said it should be like watching paint dry. So as an investor, you need to be some things are sometimes not logical, rational, consistent, boring. Do your homework. Don't just blindly follow systems, and make sure you don't repeat mistakes. The reality is, as humans, we tend to be sometimes the opposite: moody, emotional, unpredictable, too easily bored. Now, you can't be a machine, but just recognise that when you're over there, you're not in the right mindset to be an investor, so you need to find a way to drag yourself back over here, or find someone to help you who's already over here. I'll leave you with that thought. Any questions, to the usual place, please.